Everybody, ladies and gentlemen, hello and welcome here to us at Nadex. My name is Philip and I will be your presenter for today's webinar. Today it's all about the unique trading opportunities using spreads. Just a second while I work on my interface here. Yeah, as I mentioned the interface, you can see that small questions box on your screen. Right now, I would appreciate a very short yes or why on that box, and in that box to just let me know that you guys can see my screen, that you guys can hear me well. Perfect. Thank you very much, everybody. Really appreciate it. And yeah, if anything is not clear during today's webinar, just as always, if I should explain things in a different way, just let me know. And I do my very best to answer your questions as we move through the webinar. Today's session is scheduled to run for around about 1 hour. We have a lot of slides and I have a tendency to talk too much, so I try to speed it up a little bit so that we stay within the time boundaries. I'll do my very best. Of course, before we get started, there are our usual risk disclaimers that I need to make you aware of. So please take a moment of your time to read through them carefully and make sure that you are okay with them. Essentially, this says that trading, of course, involves risk and that you should understand those risks and the risk associated with the instruments you are using before you are getting active in the market. As neither Trade with Position nor myself are investment advisors, nothing that we say should therefore be considered to be actual investment advice. All examples are shown for educational purpose only. Today's webinar is just slide-based, no current market conditions. So please, by all means, do not get the idea that we are talking about live markets here and that those markets currently present any trading opportunities, at least those highlighted here on the slides. It's really just for educational purpose. Please make sure you're okay with this. Here we have a risk warning from Nadex. Trading on Nadex involves financial risk and may not be appropriate for all investors. The information presented here is for information and educational purposes only and should not be considered an offer or solicitation to buy or sell any financial instrument on Nadex or elsewhere. Any trading decisions that you make are solely your responsibility. Past performance is not necessarily indicative of future results. Nadex contracts are based on underlying instruments in these asset classes: forex, stock indexes, commodity futures, cryptocurrencies, and economic events. Nadex binary options and spreads can be volatile and investors risk losing their investment on any given transaction. However, the design of Nadex contracts ensures investors cannot lose more than the cost to enter the transaction. Nadex is subject to US regulatory oversight by the CFTC. That being said, let's just get started. Today's webinar is brought to you both by Nadex and Trade with Position. So I would like to kick off with a very brief introduction of those two companies. Nadex, of course, is a derivatives exchange subject to regulatory oversight by the CFTC, well-regulated environment. Newly formed in 2007, Nadex is based in Chicago, the financial heart of the options and futures markets. Very big plus, all contracts are settled in cash. No physical delivery. You don't have to fear that suddenly some kind of lorry pulls up your driveway and you have to take physical delivery of any market that you have traded in the past. Markets being traded on Nadex include a wide range of different global markets. We listed the asset classes already in the risk disclaimers. And how can you trade here at Nadex? Well, you have two unique vehicles to trade those markets: binary options and spreads. Today, we want to focus on spreads, understand what spreads actually are, and we want to see them in action, understand how can they be applied and which contract might be the appropriate contract to trade for a certain kind of market environment. As I've mentioned, my name is Philip. I'm from Trade with Position. We are a company founded by Nick McDonald back in 2006. And we are providing education for retail traders. Nick actually never had this idea to start a trading company or trading education company. He was just happily trading his own account and he was quite successful doing so. And at that point in time, his broker back in the day gave him a call and said, "Nick, obviously you know what you're doing. Couldn't you please teach our other customers the way you are trading?" And this is how everything got started. And yeah, as they always say, the rest is history. We have been providing international trader training for clients of global brands, including exchanges and brokers worldwide. And our educational partnership with Nadex started back in 2011. By now you will have realized that I'm not a professional presenter. I'm very sorry about that, but I'm a professional trader. And this means I'm trading those very same markets that you guys are trading. I make my living trading the markets. And this is true for all of my colleagues here at Trade with Precision. We trade the very same strategies in the very same markets. A common agenda always is put your money where your mouth is. I know this 100% to be true for all of my colleagues here at Trade with Precision and myself. We are specialists in trading strategy, which means we are approaching the markets from a very strategic point of view. We want to apply our strategies, our same patterns, our approach to trading all the time, all over again, because only then can we make sure that the law of big numbers, the positive expectancy of trading strategies actually is able to manifest itself and help us to achieve our trading goals. Enough being said, you have access to those markets here, not only from the comfort of your home, trading those markets with a PC or a Mac. The application trading interface is browser-based, but also you have access to those markets on the go using different mobile platforms. Let's have a look at today's agenda. We want to understand what spreads actually are. Binaries are somewhat simple. It's just if the price is above the binary or above the strike price, then that binary settled for $100, and if the price is below the strike price, then at expiry it will settle for $0. Just like that, easy. Spreads are a little bit more, I want to avoid the word difficult. They have a few more components, but once you understand what those spreads actually are, it's just becoming easily second nature to trade those instruments. And spreads actually can give you very nice advantages. We want to look at those as well. Nadex spread pricing and selecting the right contract. Obviously, if you have the choice to pick a contract to trade, you want to understand why you pick a certain contract. There are advantages and disadvantages of different contracts in different market environments. And you want to be aware what might make a contract a potentially better pick than another contract, for example. Practical Nadex spread trading scenarios. And the idea here really is Nadex contracts, binaries, spreads, just like futures, just like plain vanilla options, they are just means to implement a trading strategy. They are not a trading strategy in themselves. You have to have an idea of why you want to trade a market in a certain direction. This can be news-based, this can be based coming from a chart, but first you want to have that trading idea. And only then do you want to consider, okay, what might now be the best instrument to implement that strategy? And this can be a binary, or this can be a spread, or any other kind of class. But here, of course, we want to focus on spreads and binaries. We want to close today's session with a look at how you can start trading on Nadex just today. First session, first chapter, understanding spreads. And just a quick reminder, guys, if something is not clear, let me know. I'm happy to answer those questions. We're here to learn something together, and I feel that asking questions is a vital part of that learning experience. You are not interrupting my flow, and yeah, I'll do my very best to help you to get as fluent in trading and speaking options, binaries and spreads here at Nadex as possible. What is a Nadex spread? An options trading strategy simplified and pre-packaged into a single contract. Those of you guys who know a little bit more about plain vanilla option trading, there's a strategy called a vertical spread. And in that strategy, a trader simultaneously buys and sells two option contracts with the same expiration time, but different strike prices. The usual thing, let me draw that quickly in here, would be I would be buying a call option, for example, and from that price onward here, I participate in that call option, gaining money, and then I'm selling a call option. And this is my payoff diagram for this vertical call. I have bought a call and I'm selling a call. You don't have to understand that. It's just essentially this is what a spread is. I am long one call at this strike price, and I am short one call at that strike price here. And we can think of those two strike prices as the floor and the ceiling levels. And this is just what we're seeing here with Nadex contracts. We have a floor and a ceiling, and this is just the starting point at which price actually starts to participate of that contract, starts to participate in the move of the underlying market. And at the ceiling level, if price is coming higher, well, it's kept there at the ceiling. It can't go higher than the ceiling. And this is pretty much what a spread here at Nadex actually is. Has a floor and a ceiling value which limits both the upside and the downside. And this is now something very, very powerful, because you have now the possibility to actually manage your risk very, very precisely. You know exactly how high it can go, you know exactly how low it can go. And depending if you want to go long or short that market, you know exactly all the time what is my maximum potential profit and what is my maximum risk that I'm having when I'm opening and entering that position. You can buy and sell those Nadex spread contracts to create long and short positions based on the underlying market, based on your expectation, on your trading strategy, on what you think that this underlying market might be doing next. Let's do a quick comparison about between spreads and binary options. A spread has a variable payout on expiration. Why? Because it participates in the range between the floor and the ceiling. If it's just sitting there in the middle of that range, well, it's middle payout, if you want to put it like that. With a binary option, it's all or nothing. Either price is above the strike price, then that binary contract settles for 100, or it is below that strike price, and then it settles for 0. We have predetermined floor and ceiling prices based on underlying market caps, profit and loss. And here we have 0 and 100 levels based on binary option pricing caps, profit and loss. Within the floor ceiling spread, the price is closely related to the underlying market. It's not moving 1-to-1 with the underlying market. Again, you don't have to understand perfectly why, you just have to accept that's the way it is. But that is not an issue with the way that those contracts have been set up here. It's just the nature of things. With plain vanilla options, we're talking here about delta and gamma. And delta essentially gives us an idea how, with a very small price movement in the underlying, how the price of that option contract would react. And the time remaining is also a big factor here. And for that reason, yes, within that floor and ceiling range, it will move very close to what the underlying market is doing, but not exactly the same. But that's just the way it is, and that's perfectly fine. Here, price is based on a combination of market price and time to expiry. Within a spread, time decay is less significant due to the variable payouts. It's not just all or nothing, it's how far, how deep in the money and between the floor and ceiling level those contracts are. Here is really all or nothing payout. And this means that time decay is much more of a significant factor here. Price volatility near expiration is never higher than volatility of the underlying market. And here price can be very volatile near expiration if price is trading near the strike price. That's essentially from plain vanilla options. This is gamma kicking in. This is gamma actually pushing delta and making delta go crazy once time to expiry becomes very, very short-lived. Once again, you don't have to understand that. You just have to accept it, that that's the way it is. All right. I already mentioned floor and ceiling prices. So let's talk about those with a little bit more detail here. Spreads trade at various prices between the floor and ceiling prior to expiration, and the contract value will never exceed the floor or the ceiling price regardless of the movement in the underlying market. And what we're seeing here is we're looking at a Wall Street 30, which is of course our Dow Jones. We're looking at the Dow Jones in a range between 17,600 and 18,000 points. That's the floor price, and here is my ceiling price. And within that range, price of that contract will move along with the underlying market. So this means if that contract settles at 17,800 points, I will be 200 points in the money, and this is what this contract will be priced at that point in time, approximately. If the Dow Jones now crumbles and falls to 15,000 points, that contract here stops at 17,600. So the underlying market would be trading at 15,000. However, bid and offer would be sitting very close to 17,600. That's just the way those contracts have been built. That spread, it caps both at the floor and the ceiling level. Same thing is true. You're long that contract and the market shoots to 20,000 points. Your voyage ends at 18,000. Your journey ends right there, because that's the ceiling level. The market or this contract cannot move beyond that ceiling level. And you have those levels here. Very important feature. If you want to buy this market now, and you see it's currently trading here, very close to the ceiling level. If you want to buy this market, what's your risk on that trade? Well, I want to enter very close to the ceiling and to buy. What's my risk? Well, if the market starts to fall, I will participate in this whole move down until I hit the floor. And this currently here is about $375. How much is my potential profit? Well, we're trading here at 17,975. And it can go, how high can it go? It can go just to 18,000 points. So my maximum profit would be $25. And you already start to see that this is probably not the best contract to trade this market here currently to the long side. I'm risking $375 for a potential profit of 25 bucks. Very, very cool feature here of the Nadex platform. I immediately see if I was to trade one contract here, I know my maximum loss up front and I know my maximum potential profit up front. There is no guessing, there is no slippage, there is no bad things happening, there are no gaps. This is the worst thing that can happen, and if all the stars align, this is the best that can potentially happen. Very, very powerful feature, much, much better than certain kind of plain vanilla option combinations, for example, or if you were to trade futures or forex or any other market like that. You usually don't have those really hard cut, predefined maximum loss and maximum profit levels predefined once you enter that trade. Now, when the underlying market is trading below the floor or above the ceiling price range, that Nadex spread will trade close to or around its floor ceiling price. Remember, it's stuck there at the ceiling and it can't drop lower than the floor. It's within that range. And that's pretty much it. Nadex spread prices will move very little until the underlying market is trading within the floor ceiling spread. It only participates in that range. If price was to trade here below 12,400, it could move from 12,000 to 12,400 with nothing actually happening to the price of that contract. However, once it's at the trade, it starts to become in the money. Sorry, it starts to get into the money. Now it starts to participate. So if the market moves from 12,400 to 500, that 100-point price increase, that will be, the spread will participate in that price move. Question from Sherry. What if it goes past the ceiling and back down before expiration? Those contracts are settled at expiration. So this means if price is now pushing above 12,800 and it sits there and to expiration it comes back to 12,500, I will be, if I was long that contract, I would be losing those 300 points. However, those contracts here at Nadex are never fire and forget. You always can actively manage your position. This means you can say, okay, the market is going higher. It's trading at 12,800. It's trading at 12,900. And if it's very, very close to that 12,800 level, the price of that contract, I can close that contract early. I don't have to wait until expiry. I can close that position early and realize my profits there. Sherry, great question there. Officially, for settlement, it's always at expiry, but you can actively manage your position there. All right, however, within the spread range with time remaining, Nadex pricing and underlying pricing tend to have a high correlation. I've explained why it's not perfectly one-to-one, but very close. When the underlying is trading more in the middle of the spread range, there will be less correlation as the underlying trades closer to either of the spread strikes or outside the range. Those of you coming back now to my plain vanilla options, let me just quickly draw in again that payoff diagram. That's the payoff diagram at expiry. If there is still time value left, that payoff diagram will usually rather look something like that. And this pretty much explains exactly that behavior that we've described here. If we are in the range, that slope here is definitely steeper. If we are if we are above the floor, above the ceiling or below the floor level, we are very close again, and price actually doesn't move by a lot. So just that reference here coming from those plain vanilla options, why the correlation is not always one when price moves. Selling spreads, reward versus risk. Let's have a look at what's going on here. We want to sell a contract at 12,700. Well, what's my maximum risk? If I think that market might be going lower, what's my risk? It doesn't do what I think, the market will go higher. If it starts to go higher, it can go to 12,800. There's the ceiling, and anything beyond that, I don't care, because this is my cap. I'm taking my maximum pain at this price level, and that's it. So my maximum risk is 100 points. However, if things start to go my way, I can participate until a price level of 12,400. So I have a maximum reward here on that trade of 300, maximum risk 100, which means my reward to risk ratio is 3-to-1 on that trade. And I like that. That's very nice. Trading in the market is never about being 100% sure that the next trade will work out. I know that's all what we want to see. We want to see that every trade is a winning trade, but it doesn't work like that. We can do a perfect homework. We can analyze the markets most perfectly, and we can be as sure as we can be, and still the next trade will lose money. There's nothing we can do about it. And for that reason, we must make sure that we have a proven strategy that should allow us in the long run to potentially win those trades more often than we lose. And if we win, we want to have a potential profit that is larger than the loss that we have on our losing trades. And those two components coming together, this is what should give us an edge when it comes to trading. And the reward to risk ratio is that idea of the potential winners being larger than the losers. And if I'm losing on this trade here, my loss will be $100. My reward, however, if things work out for me, could be a potential reward of $300. So reward to risk 3-to-1, I like that. Let's have a look at another example, same range here. And now I'm thinking about, okay, let's sell this contract here at 12,500. This is where the market is trading right now. It can still drop to 100 points, or 100 points to 12,400. So my maximum reward is now 100. However, if things don't work out the way I want them to be, price can shoot higher to 12,800 or beyond. Beyond, I don't care. This is my maximum point of pain. The loss, however, in that scenario would be $300. And now I'm not having a reward to risk ratio of 3-to-1, but rather for every dollar that I'm risking, I just have the potential to make 33 cents. And I hope you can see that this is a much worse, much worse trade to take here based on that scenario, because here, if things work out, actually I could afford to have 3 losing trades for every winning trade. Here, I have to have 3 winners to just finance 1 loser. I rather have it that way. So always pay attention to reward to risk ratio when it comes to picking your contracts. Of course, the idea with looking at buying spreads is just the same thing. If I buy this contract here at 12,700, I just have 100 more points to participate to the upside. My risk to the downside, however, is 300 points. I'm getting that same stinking reward to risk ratio of 0.33 to 1. However, if I buy very close to the floor level, my risk is just that it drops to the floor. My potential profit, my potential target that I have, however, is that it moves all the way to the ceiling. Much better reward to risk ratio, 3 to 1, again here in that component. Let's have a look at the order interface and understand what we can see here. Well, the first thing is the underlying asset. Here we're looking once again at the Dow Jones, but of course spreads are available on a wide range of different markets, so it could be any major index future, spot FX rate, or commodity future. Next thing is we are looking, and I would like to look here at the floor and ceiling levels first. That's a spread. The floor is sitting at 17,800 and the ceiling is sitting at 18,200 points. So within that range, price of that contract will move along. And I can see here right now that the indicative index being priced, and you can read up how the pricing here at Nadex actually works on the Nadex website. If you haven't done so, please check it out. Rather interesting read. Currently, the market is being priced here at 17,994, and you can see this is pretty much here within the bid and offer. That's currently the spread price. That's the price where this spread currently is trading. Like any other option contract, at some point in time, this contract expires. Judgment time. Where is the underlying market priced? Is it worth something? And if it is worth something, how much is it worth? This is what we can see here at the expiration time and date. This contract expires in the afternoon, 4:15. Now, let's have a look at that example here. If we were to sell this contract, the market is currently trading at 18,000 points, which is, where is it? It's just sitting here at the ceiling. Perfect for a potential short trade. Why? Because if I was to sell one contract here, what is my maximum loss? Well, my maximum loss immediately shown here is just $29. I'm sitting very, very close to the ceiling level here. I can sell this contract now for 17,972, and you will see that the difference here really are just those $28, $29. So that's my maximum loss because I'm selling right at the ceiling. My maximum potential profit, however, is that price starts to drop from 18,000 to 17,600. And if it drops to 17,600 at 4:15, my maximum potential profit would be $371. Outstanding reward to risk ratio. We have to have a look at the chart and think if it's really working out like that, if it's possible for price to move in that magnitude of a price move within the period of time available. We have to balance those things. But these are the pure numbers. Maximum loss, just $29. And no matter what happens, I can't lose more. Very important and powerful feature. The maximum profit, much, much larger. If you think the market is going higher, if you're just starting out, you might think, well, let's just buy this contract then. Bad idea. Why? Because it's capped at 18,000 and we're sitting just there. So I can buy this contract now for 17,975. How far can it go? No matter what happens, if price shoots to 20,000, it will stop at 18,000. So my maximum profit here is just $25. And my maximum loss, however, price starts to reverse, go to 17,600 or below. My maximum loss is 375. I hope you can see that this here really is a bad contract to trade here on the long side. However, if you were bearish on that market, this here would be a very, very alluring contract to analyze further and to see if it actually fits within the other parameters of that trade. All right, so what are the advantages of trading spreads? And just a quick reminder, if there are questions, just let me know. If you want to trade futures, if you want to trade the underlying spot markets, if you want to trade stocks, usually you have to have a big bankroll. You have to have a lot of money to get started there. Here, however, the startup capital requirements at Nadex are really, really small. Trading on Nadex starts with as little as $100. You don't have to pay any platform fees or minimum trading requirements. You have one single account to have access to trade all those different markets. You can consolidate your cash to trade contracts based on spot FX, commodity futures, and index futures. And if you think about it, it's good to have a broad variety of different markets. You don't want to have markets which are clustering too much, which have too much correlation. If you were only to trade the index futures, guess what? If the S&P 500 is going up, guess what the Dow Jones and the Russell will be doing, for example. It's pretty much the same story. You want to have the possibility to diversify, for example, into forex, into commodities, what is gold doing, and so on. All this is possible here from your Nadex account. Invaluable supplemental tool for the experienced trader, great introductory tool to new markets for the novice. Risk management actually really is paramount. You want to understand how much risk you take with those trades. Risk management is, I feel, one of the most important things when it comes to trading, because risk management is for survival. You must make sure that you survive your next trade. Your next trade must never be able to wipe out your account. This is the one thing that all the great speculators, investors, traders, scalpers, no matter what you want to call them and what specifically they're doing, they all agree on the importance of risk management. So how can we approach risk management here with spreads? We want to have flexibility, we want to have simple money management, and for that reason we want to carefully select our order price and maximum potential loss. You remember, we see immediately how much money can we lose if we were to trade that contract here. And now the idea is, with the risk management, you want to, how do I explain it? Risk management actually comes with two components. First component is, let's just assume I just opened my Nadex demo account with $25,000. I want to risk, let's just assume, 1% of my account on any one single trade. And this means 1% of $25,000, I want to risk $250 per trade. If that trade doesn't work out, it's okay for me if $250 are gone. And now the idea is, what is my position size? I'm seeing here, if I was to trade that contract here, that per contract, my maximum loss would be $8. And now the idea would be, okay, how many contracts can I trade for my maximum loss to be just $250 or less? So if I'm not completely off here, I think the correct answer should be something around 30 contracts. And this is how you do proper position sizing and risk management. What's my maximum loss per contract? How many contracts can I afford to trade to stay within my 1% risk parameter? And this is why it's so great to trade here on Nadex. You see that number. You see it immediately. It's so easy to stay in line and make sure that you adhere to your risk management principles here. Very, very powerful features. We have talked about the wide range of markets reflecting those underlying futures and different sectors. We have a look at energies, metals, agriculture, and you can see it's crude oil, natural gas, gold, silver, copper, corn, soybeans, those different months out there. And yeah, you have access to all those markets. No need to open a futures broking account. You can trade those markets here really with spreads, with binaries at Nadex. US indices, European indices, especially the German DAX, the Germany 30 is going quite strong recently. The FTSE 100 is also rather interesting. You have access to the Nikkei, Japan 225, many different markets available for your trading here. And another big benefit is, if you look at the usual tick sizes, which means if the S&P 500, for example, if the E-minis move by $0.25, So, yeah, if they move by 25 cents, that move of 25 cents in the index is worth $12.50 just due to the contract size of the futures. With the mini Dow, it's really the minimum price fluctuation is $1, and this would result in a P&L difference here on $5. So the minimum future stick value, $12.50. Sorry, guys. With a silver future, it would be $25 and so on. Here with Nadex, much smaller movements, much easier to price those options and trade those options, also for small accounts. Overall account risk is limited. When you place a trade, your maximum risk is clearly displayed. This is so much better than trading just spot forex. You have to do a lot of fancy calculations just to transform the risk into your base currency, base account currency, and there are a lot of different ways to screw up. Here with Nadex, it's really, you see that number, you see that figure, and you know what your risk is. The collateral required to take that trade is the maximum risk that you see here. The amount that maximum risk is held by Nadex. So for example, on a 200-point spread contract, if you buy at 35 points above the floor, your maximum risk is or are those 35 points. So $35 will be held until the trade is closed out. You don't have a chance to actually drop your account below zero here, because if you don't have that money unheld, unsecured in their account, you won't be able to open that position. The seller on the other side has sold at a risk of 165 points. It's just taking the opposite side and will put up the remaining $165 collateral per contract. So you don't have any counterparty risk. You have no credit risk. Nadex makes sure that both participants in that transaction have deposited their collateral, and therefore those contracts can always be cash settled. Sherry is asking, what if there is no seller? If you have a look at the order interface, you can see with contracts you have a bid and an offer. Nadex is providing the marketplace. Nadex is the exchange. Nadex is not your counterpart. Very powerful feature, you're not trading against Nadex. Nadex provides you with an organized marketplace here. And for that reason, if there is nobody willing to take the other side, then probably that contract is too far in the money or too far out of the money. And the other market participants just don't feel like it makes sense to take that opposite trade. If that's the case, try to have a look at different strike prices at different ranges. And once you come closer to where the market is actually trading, it should be pretty easy and straightforward to find somebody to take the other side. All right. Mike, I'm not quite sure I understand that question. The question was, can you explain any advantage to entering your own strike price in a forex spread? You take the strike prices that are with the contract. You take the floor and ceiling prices, and you can just trade those which are there. I assume you mean if I want to enter a different bid or ask bid or offer there, and that's a good idea to do if you want to place a limit order, for example. If you think I want to scale out of my position, I have just entered here at 35 points. I know the market can still move 165 points, but why not close out a part of my position if the market is trading up another 35 points? So I have a one-to-one reward to risk ratio, so I'm closing that position there with a limit order. Once I have the market, the price of the contract has gained another 35 points, for example, in my favor. Once again, you can actively manage those spreads and positions. You don't have to wait until expiry to see what actually happens there. Just a second. Guys, no problem. You're absolutely welcome. That's what we're here for, and thank you for those great questions. All right, guys, so keep in mind, you can never lose more money than what is in your trading account, and you see the risk when you enter the transaction upfront. All contracts are cash settled, no physical delivery, no worries about that lorry pulling up your driveway. The range of spreads available. Contract selection varies based upon the market. Index and commodity futures are available on hourly and daily expiry cycles. Forex is available hourly, 5-hour, 8-hour, and daily expiry cycles. 70 contracts per currency pair per day. And here we have a list of those different contracts, for example, on the Aussie, Australian dollar against the US dollar. Here we can see we have a range of 74 to 75, 73.50, 74.50, and those expire at 1 a.m. How can you pick those different contracts here? You just pick them here on the navigate menu, and you pick first the market that you want to trade, or the asset class, the underlying market class. And once you have the idea that you want to trade forex and the Aussie currently looks interesting to you, then you pick your expiry cycle, and there you have a look at the different contracts available there. Henny is asking about the number of contracts on available for trading. As long as you have enough collateral, and as long as you have enough money in your account, and as long as you find counterparts to trade with, which should be pretty easy if you're trading at the money and where the market currently is trading, you should be good to actually trade as much as you want. I don't know of any limitations there, so be happy to go there. And once again, it would now be nice to know where the underlying market was trading, but I assume if you see 73, 74, and there's just one bid and that price is at 74, well, this means probably the market is trading above the 74 level. It just doesn't make sense to offer this price here. Probably the market is trading at 74.17, something like that, just here in the middle. All right, guys, so let's move on to the next slide. I'm terrible with my timing. I already have to confess that yeah, I have to speed it up. Benefit, traditional stop losses are not required. Usually, if you want to trade those markets, you always have to have a stop loss location, because you want to get out of your trade when things start to go in a different way than you had anticipated. You should never be hoping when it comes to trading. You don't have to do this here with Nadex contracts because you know your maximum loss. And if you follow that algorithm which I just outlined when it comes to position sizing, I'm willing to risk $250, 1% of my account. My maximum loss per trade here or per contract is $10. How many contracts can I trade? Well, it's 25. I'm automatically in line with my risk management. I don't have to have a stop loss in place. So risk is being kept, very powerful, and price can move beyond the floor ceiling, and it's still, I'm not taking out, it's not some kind of knockout option, it's things can come back. And it doesn't make really sense to close a position with a lot of time remaining, and which is sitting there at an end of the spectrum, which just is not favorable for you. You just can wait it out. No need to take that loss early. Maybe time is on your side. I think it was the Rolling Stones. Direct market access exchange. Nadex is the exchange, and you trade with direct market access. You can place limits at your preferred trade price, even within the current bid-offer spread. Tighten spreads yourself. You can make your own market. It's once again, look around. Nadex is an exchange. That's a very, very powerful feature and distinction. Just keep that in mind. Nadex spread pricing and selecting the appropriate or the right contract. We have to price in time and volatility. Spreads do not generally have a large time element priced into the contract. However, time clearly plays a role. The contract price should be tracking in line with the underlying, provided it's within the floor ceiling range. Remember that small graph that I painted. As long as we are between the floor and the ceiling, we should be highly correlated to price movement in the underlying. So just a second, here we are. Price tracking in line. Here we are looking at different contracts. We're looking at a Wall Street 30 Dow Jones. Narrow contract snapshot over last 3 to 4 hours of trading. And we see now what price is doing. Price is pushing lower here. And where is this market trading? We're looking at the 12,500, 12,900, and we're sitting here very close to the 12,500 level. It's 12,600, 20, something like that. And now price starts to go higher, and you can see the market follows along. The market has been going higher for about 70 points. And guess what? The market here went higher for about 60 points. Not one-to-one, but very close. Once price starts to come back lower again, guess what? Price is declining here on this contract as well. This is just to give you an idea. And guys, this is the main point why it's so important to use that demo account here. You can just play around. You can have a look. It's a risk-free environment. You can just get a feeling for how everything is working. You can play. You can you can get your feet actually wet. Ward is asking, are bid size and offer size the total number of bids for the contract? Ward, yes, at the current price level. It's not the complete market depth at that stage. It's for this bid price, we have this bid size. We have for this offer price, we do have this offer size. You can, if you go to the order ticket, I think we have a little bit deeper, and we see further levels here on the order book, but here in this overview, it's really the top level. Richard, yeah, the platform is web-based, so just feel free to sign up for the demo account and play around, and you will see how easy it is to work that platform. There are some exceptions when price tracking actually is not in line. Price may not be in line with the underlying when Nadex spread contracts have just opened for trading, and there's a long time left within that life cycle of that option, or if spreads are trading close to their floor ceiling with significant time left to expiration. Be prepared to factor in extra price for the time advantage until expiration. As long as there's more time, the market has more time to move in a certain way, and that supports or wouldn't support your position. But this time is just worth something, because within time things can happen. As time passes, however, the spread contract price will gradually get closer to the underlying market price. Here we have an example where price actually is not in line. We're just getting started here, and you can see with 2 hours, 37 minutes to expiration, we are paying for that privilege. There's a lot of time left within that contract. Next thing that we see is we have just 90 minutes to expiration. Price is just sitting here pretty much at those same levels, and with just 30 minutes to expiration, same thing, same price level. So we expected Australian dollar, US dollar to decline from a certain price level. However, guys, sorry, not that I'm telling you. Yeah, no, guys, sorry. That's those are different prices and different contracts here available for your trading. That's the 7 a.m. contract, the 6 a.m. contract, 5 a.m. Sorry, guys, I was a little bit confused here and at the moment. So why are those contracts here priced pretty much the same way? Well, we're paying here extra for the privilege, and that range here still is larger than the previous ones. And within those contracts here, they are now closer to expiration, and that time benefit actually there is gone. Time limit risk on trades. While time decay is not a significant risk in the pricing of Nadex spread contracts, it is vitally important that you give your trade sufficient time to work out. Remember, there's expiry, and after that, that contract is gone. It's gone for good. There is a potential opportunity cost that the market will achieve your target, but only after expiration time. Let's have a look at an example here. And Jay is asking about the recording. Yes, we do have a recording, and that recording, I'm pretty sure, will be shared either with you guys directly after the webinar or on the Nadex website. Jay, just keep your eyes open. I'm pretty sure you will have access to that recording. Here we're talking about a chart about crude oil, which is not crude oil, but the small cap, the Russell 2000. Numbers are the same, so please ignore the crude oil here. We're looking here at a short setup. We think that price might be pushing lower. Why do we think that? Series of lower highs. We have identified a level, and now we are about just to break below this level. And guess what? The price at this level here is at 1813, and the ceiling level of that contract is 810. So we are entering very, very close to the ceiling, which gives us a maximum loss here of $42. Our maximum profit, however, if price starts to push lower, actually is 208. So 5-to-1 reward to risk ratio, which is really nice. But of course, we have to make sure that things work out. This contract goes for about 14 more hours. We mentioned the good reward to risk ratio. So let's have a look at what actually happens. Sure enough, price started to fall. However, all this happened here really just in this big one red candle. And guys, sorry, I have to move my interface a little bit so that I can highlight the area here. So all this happened here really in this one candle. And guess what? We were right on the setup, but timing just wasn't on our side. Price actually started to push higher before finally falling apart. And that contract expired when price was sitting just there. So we were right in the general direction, but we were wrong with our timing. So the trade resulted in a small loss at expiry and later continued in the expected direction. Do we like that? No, we don't like it. Does it happen? Yeah, sure, it happens. It's all part of the game. How can we approach this? There are two possible solutions. You want to be vigilant in selecting expiration time and where possible choose the contract with the most time left. In the end, you have always to think, okay, how much time is left? How many bars can form on that chart until expiry? And how far has price to travel to hit my level? And do I think that's possible based on the volatility, on the movement and speed and of the size of those candles just happening over the last few bars? And if I think that's possible, okay, let's go for it. If I think, no, that's too far away, there's too little time left, maybe I want to think things over and maybe look into a different contract. Another good idea might be to split your trade across multiple contracts with different expiry cycles, expiration times. Let's have a look at this one here. Well, if I think the market is good moving in that direction, I could be going for the 1 hour expiration, or I could be going for the 7 hour expiration, or why not go for both? But once again, risk management. If I want to risk $250 on my demo account on one trade here, do I risk $250 now on each of those two trades? No, I don't. The total risk exposure, the total maximum loss of both tickets here should in sum be those $250. Those markets, it's the same market. It's highly correlated. I don't want to take more risk than that's good for me. So 1% splitting up on those two contracts, and I'm just diversifying now my time horizon. All right. The risk, of course, when selecting the wrong contract, could create an undesirable reward to risk ratio. You click buying instead of selling, or just the other way around. You have seen how terrible this can be if you buy near the ceiling. Your contract has no more room to the upside to actually work in your favor. If you sell near the floor, same thing. If price starts to drop, you got the direction right, but it's unfortunately you don't participate in that move. Keep in mind, you want to see that you pick a contract where you sell near the ceiling or where you potentially buy near the floor. All right, some practical Nadex spread trading scenarios. Here we are looking at Aussie against the US dollar, and it's trading exactly at its ceiling with 2 hours to expiration. We see the market is in a downtrend. We're trading here very close, 73.70, very close to the ceiling level. If I sell this contract now, my maximum loss is just $6. My maximum profit, however, 194. That's a trade here with a great reward to risk ratio. No need for a stop loss placement because I know my downside. I can scale my position accordingly. The 1-8-30 contract offers a low risk scenario of just 15 pips, where a sensible stop loss in the spot market would be approximately 40 pips at just above the high. I want to enter here on a move to the downside, and my stop loss location would be sitting here near the recent swing point high. Takes too much time now to explain why, but that would be the appropriate stop loss location. This contract here now is just only 4 pips out of the money and provides a great reward to risk ratio for that trade with plenty of expiration time. What do we have here? We are entering here very, very close to the ceiling, and we have that whole distance to travel to the downside. One takeaway from today: if you want to buy, try to buy close to the floor. If you want to sell, try to sell close to the ceiling, and balance with your time. The result that we have here is price fell apart, price broke to the downside, and the trade could have yielded a potential profit of 3-to-1 reward to risk ratio. The 15 pip risk scenario and the resulting 3-to-1 profit was much better than what the spot market could have given us there, because our stop loss location would have been here. The position would have been much smaller because we would have to accommodate for that larger distance here, and for that reason, that small risk, this is how you can accelerate your and make that reward to risk ratio actually work for you. Selecting the optimal contract with a bullish bias here on that trade. The first 2 contracts are in the money, and the third is out of the money. Well, where does it actually start? We can see the red box here doesn't make any sense. We are bullish on this market. We want the market to go higher. We are sitting already above the ceiling. Doesn't make any sense at all. The blue box is just where we are sitting here right now, and price is starting. We participate a lot in that move, and there's a good potential here for the upside. With the green contract, we're just sitting in the middle of the range. So our reward to risk ratio here is pretty much a 1-to-1. Doesn't make sense. The blue box here, the blue contract, where we're entering just very close to the floor level, that's the perfect contract to pick here. Price broke up to the upside. The trade resulted in a 50+ pip profit and a 2.5 to 1 reward to risk. The green contract would have yielded just 10 pips additional profit for the extra risk of over 60 pips. You have to start to think in those reward to risk ratios, and what money is at risk and what additional gain can you get of that out of that contract. A slightly out of the money contract, what we're looking at here, the green one, price has to travel a bit to just come into that range. Remember, if we are outside the box, outside the floor and ceiling levels, price won't participate, or at least not that much. So that first travel distance here is pretty much wasted. We won't participate. If price, however, pushes there and moves beyond, then in this whole setting here, we will participate. So if it's slightly out of the money, and I would consider that to be slightly out of the money, that's acceptable, but it wouldn't make any sense at all to just go for something where the floor level is sitting here, because all this move to the upside, I'm not participating. It's not doing anything for me. I want to be in the money as quickly as possible with spreads. This example here, 30 pip plus profit over 4-to-1 reward to risk ratio. Why was that reward to risk ratio so good? Because we entered not at the floor level, but rather out of the floor level. So minimal risk when opening that trade, and therefore that trade quickly generated money for us. Now time's pretty much up, and yeah, I try to speed it up even further. Sorry guys, we will be a little bit over time. Looking at this setup here, what's going on here? We are in an uptrend. Price has pulled back. And guys, if you don't know to read those charts, have a look around on the website, have a look at our advanced courses here, available in the Nadex archives, or once we run those sessions live again, you will be able there to learn to read those charts and scan for those setups, which have, we like to call them high probability setups. Once again, you will never know for sure if it's going to work out or not, but over a large sample set of trades, you should be able to come out ahead. Pullback, beautiful uptrend, bullish reversal candle setting up, and now we're expecting a trend continuation. What are the available options here? 88.10. Where are we trading here? We want to have something very close to 88.500. We want to enter at 88.500. 40, 60, that one is slightly out of the money here. Even further in the money here, even further in the money. So personally, I would be probably going either for this contract here or that contract there. They both have the same expiry cycle. Shorter lived, longer lived, those two. I would be picking one of those because those are, we want to enter a bullish position. We want to enter as close to the floor as possible. And either of those two contracts here might be working out for that one. So what did happen? Price actually did not move the way we hoped it would move. Once again, we never know what's going to happen. With those contracts here, however, there's virtually no profit or loss on those contracts. The 88.60, 88.960 would have expired at the floor price for a capped loss of 8 pips. Yeah, nothing really to write home about. News trade, one final thing here, rather powerful. We are now here just 4 minutes before a major news event. And we're sitting here right at a price level. And this level here happens to be the floor level of one contract and the ceiling level of the other contract. Now, if you think that news is able to push and move the market big time, what you could do is that you buy that contract where this price level is the floor level and sell this contract where this level is the ceiling level. They don't net each other out because this contract participates completely on the upside and this one completely on the downside. With the downside, with the risk on both being well defined. Here we have a maximum risk of $9. Here we have a maximum risk of $30. So if I take that trade and if price doesn't do anything, it just sits there, my maximum total loss should be no more than $39. Once price starts to move, minutes after news release, the long contract, prices start to push higher. It's now in the money and it's already hitting my one-to-one profit target. It has the potential to move higher. The short contract may expire at the ceiling, or you could hold until expiration with your losses capped to see if it turns profitable on a reversal before expiration. What you could do, price starts to push higher, you take your profits there, close that position, but you don't have to close that one. You can easily wait and see, maybe the market is coming back and give you the opportunity to take also profits here on the other leg. All right, guys. Start trading on Nadex today. You have seen that spreads are a little bit more complex than binaries, but not really that difficult. You have a floor, you have a ceiling, you participate within that range. If you want to go long, you want to go long at the floor level. If you want to go short, you want to go short at the ceiling levels. Spreads provide a variable payout with minimal time decay, much different than binaries. Selecting the right contract allows capped risk with significant upside potential. Low minimum tick size of just $1 offers another advantage over the underlying futures markets. And you can trade global indices, spot FX, and commodity futures from one single account. Nadex is the exchange. You trade with direct market access. Always keep that in mind. Guys, sorry for rushing a little bit towards the end and being a little bit over time. Thank you very much for tuning in. If there are any questions right now, I'm more than happy to answer those questions. And in the meantime, you can see here how you can get started with at Nadex. Visit the homepage, sign up for a demo account, and by all means, this 40-day demo account that's outdated, it's now unlimited. You can sign up and practice as much and as hard as you want to, and I really suggest that you do, because practice makes perfect. You see those elements, those instruments come with a little bit of complexity, but I'm pretty sure after 1 or 2 demo trades, you will feel just right at home. All right, guys, looking at the questions, but I think we are good. So yeah, guys, thank you very much for tuning in today. And now have a lot of fun to practice and trade those contracts here at Nadex. It would be awesome to welcome you guys again on our next webinar. So please make sure to sign up for those. And now to all of you, have a great trading week. Thank you very much for the great participation. And yeah, happy trading. Thanks again. Take care and bye-bye.